Hello, everyone, and welcome to another lesson. We're going to be looking at Chapter 2's content. We'll be covering the first part this week, and then we'll continue with the rest next week. Just remember, you need to go over Chapter 1's content because you need to understand what the primary goal is of a business. It's important to also understand the differences between financial accounting and financial management. So I hope you've gone through week 1's content. I hope you've checked all those activities that are part of the actual textbook. And if you have any questions, please feel free to send me a message on Cole Campus or join the WhatsApp group and ask a question there, or you can also email if you prefer. Just remember, when looking at content in the actual textbook, it's important to understand how this would apply in practice. So when you look at Chapter 2, you'll see we're going to be starting with more of the accounting. We're going to be looking at the objectives and the purposes of accounting and the overall record keeping process. So it's something that's very important in terms of application because we obviously need to generate financial information for users to make use of the information when looking at making decisions. So when we look at Chapter 2, just keep that in mind. We're focusing on accounting specifically, and we're trying to understand what the purpose is and a little bit about its background in terms of how the system was created. So when looking at Chapter 2, just remember its context, its background, and it's going to lead to the more practical accounting, which will start in Chapter 3. Chapter 3 is where things get a little bit more hands-on in terms of activities where you're actually going to be doing workings and calculations that will require you to apply accounting basic principles, the double entry system, etc. So please just appreciate how important it is to have the context and the background and the overall understanding of how accounting and financial management actually fits in with all businesses. Remember, all businesses need to use a form of accounting to keep track of their records. And that's something that we've touched on in the past when we spoke about the main differences between accounting and financial management. The first thing we're going to have to look at here in Chapter 2 is the overall introduction. Just remember that there are certain important objectives that you need to take away from each chapter, and that's outlined here in the actual introduction. So if you look at the introduction, it's obviously important to understand what the main goal is of a business. So we've spoken about the primary objective. The primary objective is not solely to make a profit. Profit is part of it, but it's actually more. It's more than that, and that's why when you look at the value that's being created, that's the first goal, and then obviously profitability would be generated over a period of time. So yes, entrepreneurs do place quite a lot of emphasis on profit, and that's because of the accounting background or the accounting focus that's being put at the forefront of the business. So please just appreciate that when you look at Chapter 1's content, you need to understand that accounting is just like any other language. It's a language for communicating information. If you've got the ability to interpret and understand that information, you have an advantage. And we spoke about how competitive the world of work is, obviously. So if you're going to be applying for a particular job in the media industry and you're looking at becoming maybe a manager or a director or an executive, obviously you are going to be able to make better decisions if you have a good sound background and understanding of these financial management and financial accounting principles. So just remember, when looking at this particular course, it's there to provide you with knowledge and information to give you a skill that you can apply in business and in other areas of your life as well. Accounting and financial management is quite universal. Individuals need to keep track of their finances. Businesses need to keep track of their finances. So it's a very universal skill that you can make use of in all areas of your life. So what I'm going to just highlight here is just the overall objectives. Obviously, we need an overview of accounting. So where did the system come from? We need to know who actually uses this information and what do they use it for. Okay, so the users are people that use the information, and obviously the uses would be what they actually use it for, so the purpose. And then we're going to be looking at principles of IFRS. That's very important because that's going to be our basis for accounting rules and definitions, and we will be looking at that soon, because chapter 3 is when we're going to be starting with the actual application of accounting. We're also going to be talking about the accounting cycle. Okay, that's very important to understand, because there's a process to everything. Even now, there's a process to your studying or your learning. We need to start with chapter 1, and then we need to progress, and at the end of the year, we'll be covering the final few chapters, and then you would have covered 12 chapters during this particular year. So just remember, everything follows a process, everything has a cycle, and the same applies here. We need to follow the steps when looking at presenting or creating financial accounting information for users. We are going to contrast the differences between financial and management accounting. We're not going to be doing that in this particular session, in this video. We will be picking up on that concept a bit later on when we cover the remaining few pages in this particular chapter. All right, so as long as you're keeping up with me and you're going over the week by week content, you're not going to fall behind, and you'll stay on track. So as I said, please just keep up with your work. As a bare minimum, please watch the videos and have a look through the textbook to familiarize yourselves with the course content. Don't forget to do those self-assessment questions, and you can test those, test your knowledge, and then you can check your answers in the actual textbook that is provided. And then the last thing we'll obviously look at before we wrap up this chapter is different types of transactions. And that's a nice way to end this particular chapter, because in the next chapter, chapter 3 is going to deal with the actual accounting analysis. So we're going to be looking at how are we going to interpret transactions, and how are we going to make decisions based on what we know is happening from a double entry point of view. So that's just a little bit of context just to get you started. Just to give you some background regarding the brief history of accounting. What is accounting? Well, last time I referred to process and I referred to NASPers. Those are two of South Africa's largest companies in the actual country. So when you're looking at NASPers and process, and once upon a time they were actually one and the same, and then more recently they had split into two separate companies. Very, very valuable companies on the JSE, and they are public companies, so you will get an annual report from these companies every year. If you go look at the actual contents page, you will see a whole bunch of different areas that they need to report on. Obviously, accountants need to cover a lot of different, let's say, categories of information, and one of the things that you would obviously see in an annual report would be the statement of financial position, statement of comprehensive income, statement of changes in equity, and even a cash flow statement. So you'll see here you have consolidated annual financial statements, and those are very, very important in terms of decision making, because you can look at performance and you can decide whether this company is doing well or whether they're not. And that's something that all users need to understand. So to touch on that concept, a user would be someone that would take this information and make a decision. You can see here, just in terms of the different business, let's say, areas, you can see with the e-commerce global consumer internet portfolio, obviously there's lots of different subsidiaries. Okay, so in other words, smaller companies under each of these. But you can see here revenue, trading profit, and employees. Okay, they're reporting on information that's important for users to make decisions. Okay, maybe you're looking to invest and you're looking to purchase shares in this particular company. Maybe you're looking at NASPers in terms of management and management making decisions on how the company is performing, which of their business units are doing well and which aren't. So please just appreciate that when you do look at this information, it's information based on operations. It's based on the company's ability to perform over a period of time. And even Media 24, you can see, is obviously South Africa, or Africa's Africa's leading print and media digital group. Okay, so you can see that based on what we have here, there's a lot of information that's available, and you can obviously look at performance in each of these businesses. So just remember, when looking at reporting needs to be done accurately, and obviously accountants are responsible for that function. They're going to be generating that information. So just some brief history, just to give you some more context. Okay, you're looking at the world today. In other words, what's happening currently in terms of reporting. But how did the system actually start? Where did all of these financial statements come from? If I just go and scroll down to the bottom to show you a little bit of the structure here. Okay, statement of consolidated, income statement. Okay, summarized consolidated income statement, obviously showing income and expenses. Okay, so when looking at this information, you can obviously see that Naspers is doing very, very well. They are making a profit. Okay, the profit was a lot bigger in the past, but obviously taking COVID into consideration and the global pandemic and all of that, obviously for the year in 2020, it is going to be affected by things like that. So all businesses go through good and bad times. Sometimes businesses do make losses even. Even if they made a loss, this business is not going to close because this business would obviously have lots of assets. And those assets are important because we spoke about value and how important it is for companies to create value. And if we're looking at the value that's being created in the company, even though they might have made a loss in 1 year because of a global pandemic or other, those businesses can survive if they manage their finances correctly and they continue to operate. So just remember that profit's not the motive. Accountants, yes, emphasize profit a lot because accountants measure profit because it's objective. You can measure the income, you can measure the expenses. But how do you actually measure the value of a particular company? How do you know how much the company is actually worth? That's a lot more subjective. So just remember that when looking at accounting, it's a system that was created many, many, many years ago. If you look at the background here, which you can actually read through, I'm just going to highlight a little bit of the background regarding the actual father of accounting. Let me just see if I can find it here. There we go. Okay. Luca Pacioli was born in 1445 in Tuscany. Obviously, we're looking at business. We're looking at a double entry. So if you go back and you really take it back to its roots, obviously the origin of accounting can be tracked many, many, many years ago because for as long as business has been around, people have been wanting to record and keep track of assets and their performance in terms of maybe sales and so on. So just appreciate that business is simple, but it can also be helped with the additional information that you derive from your transactions and your analysis of those transactions. So when looking at the history and how the system had evolved and changed over a period of time, the most important development was obviously the double entry system. And that was only developed more recently. Okay, when I say more recently, we're talking about the 1400s. Okay, that's a long, long, long time ago, but obviously a bit more recent compared to what we saw here over 5,000 years. All right, so that's a little bit too far back, and we're not going to go that far back. But when looking at the father of accounting, obviously Luca Pacioli was a businessman, and he was thinking about a way to keep track of transactions to make sure that business people could transact and they could make decisions and they could have information that could be used to their benefits. So you've probably heard the saying, knowledge is power. Knowledge is power because the more you know, the better. And if you know something that someone else doesn't, that's an advantage. So you should always view accounting as an advantage. Businesses that have good accounting records, businesses that keep track of all their transactions, and businesses that report on their transactions have an advantage because they're monitoring and they're managing all the activities of the business. And that's very, very, very important because if things aren't working or if things need to be improved, you have something that's measurable that can be identified, and you can change it if you can measure it or if you can analyze it. So keep that in mind when you look at the system. A double entry system is just a system to keep record of transactions. And something else maybe to mention here as well is that buyers and sellers are involved in a transaction. So you always have two sides to the transaction. And that's also vital to understand, because when you look at the double entry rule, there's always two sides to the transaction. So if you buy something, okay, you're the buyer and you're buying something from the seller. You've got two different sides of the transaction. So when looking at the double entry, which we will get into in more detail in chapter 3, for now, you just need to understand the history and the context surrounding accounting. Remember, accounting is a method to keep track of information, and that method to keep track of information is important because it provides the business with an advantage. More knowledge is power, and that's exactly what accounting provides us with. You can go through more of the basic history if you want to. It's not so important to understand how the system was created. It's more important to know how the system is used in today's context. And we will only get into that a bit later on when we cover chapter 3. For now, just appreciate the differences between financial accounting and management. In this chapter, we're focusing our attention on the accounting side of things. The first thing that we need to establish is who uses this information and what do they use it for. This is a very important consideration, because if you understand what the purpose is of accounting, you'll then be able to use it appropriately. So there are different roles here that I would like you to look at. The textbook explains each one in some detail, but they don't emphasize the actual use in too much detail. Yes, they give a general overview, but they're not very, very, very specific. So I would like all of you to please consider when looking at each of these headings. So for example, investors, employees, labor unions, lenders, what are they actually going to be using the information for? And I will post more discussions in the actual or on the actual Cold Campus platform, and I encourage all of you to please engage on the platform to answer some of the questions that are posted there, to see if we can apply some of the knowledge that you have acquired from the first few pages of this textbook. We've already reached chapter 2. Okay, chapter 1 is very short. Chapter 2 is giving you a little bit more insight onto the accounting side of things. So the first thing we need to establish is the user. Okay, the user would be the person that's going to use the information. So investors are obviously going to want to invest. So picture yourself being an investor, and you had two separate companies, Process, okay, and Naspers. Remember, Process and Naspers are separate companies. They're both listed on the JSE. They are public companies. So now, if you are an investor, are you going to invest in Naspers? Are you going to buy shares in Naspers? Or are you going to invest in Process? And are you going to buy shares in Process? How are you going to make that decision? Obviously, you can't invest in both, or you can't, let me say this, you can't invest equally in both. So if you've got, let's say, R1,000,000 to invest, yes, you can split the million, but you can't put R1,000,000 into Process and R1,000,000 into Naspers if you only have 1,000,000 to invest. So the important point is, how do you make a decision? How do you choose who to invest in? And the answer to that question lies in the accounting, because the accounting is going to generate a view and it's going to provide you with information. And with knowledge comes power. If you can analyze and interpret that information, you can then make an informed decision. Remember, if you're just making decisions without thinking, then you're guessing, or you're taking a chance. Okay, you're not making an informed decision. Right? Information is valuable. Right? You make decisions based on information. And that probably applies to all of you in terms of your past experiences. Maybe think back to a time where you made a decision where you didn't look at the information. And sometimes those decisions don't always turn out so well. Sometimes they do, but if they do, it's pure luck. Remember, when we're looking at business, we need to remove the element of luck. Okay, remember, businesses don't guess, or they shouldn't at least. Businesses should make informed decisions, because remember, they have investors or they have shareholders that they need to report to. Remember, businesses operate on behalf of their shareholders or their investors. Then you've got other role players like the employees and the labor unions. Again, in terms of users, what would an employee and a labor union use the information for? Well, again, there could be a whole bunch of different reasons why employees would want to look at the financial statements of a business. Right? If you're an employee of a company, you obviously want to know how well the company is doing. If the company is not doing well, or if there's a decline, or if the company is going through a difficult time, or there could be retrenchments, etc., etc. Those are things that you need to be aware of, because that's obviously going to affect your ability to work and perform as the employee. Labor unions are important because they obviously represent the employees, and they want to know that employees are being treated fairly by the employer. So in South Africa, we have very, very good labor laws, and that's obviously to protect the employees, because there's nothing stopping companies for taking advantage of their employees. So just remember that when looking at the user, we need to look at the information that's being used. So what would an investor look at? What would an employee look at? What would the labor union look at? Those are things that you would have to discuss, identify, and share with the class. So please use the Cole Campus platform to answer those questions. I will post a discussion note on it. And then we've got lenders. If you're going to be lending money, obviously the lender is the person giving the money to the other party. So would a lender give money to a business that doesn't have financial records? The chances are probably not. Okay, you might, but then they're taking a huge risk. No bank or no lender is going to give a loan to a business that doesn't provide proof that they're operating correctly, or that they're operating profitably, or that they're operating in a specific way in order to generate revenue or income for the organization. So just remember that a user has a different objective. Investors have their own objective, employees have their own objective, labor unions have their own objective, and so do lenders. There are others as well. If we look at more third-party providers of benefits in terms of suppliers giving us stock, and trade creditors. Okay, trade creditors would be people that we owe. So they would provide us maybe with goods or services, and we would have to pay them back. Customers would also want to know what's happening in a particular company. Maybe a customer likes a particular company and they want to do more research. So there are different reasons that people have in terms of doing their research or finding information on these types of businesses. Then we've got governments and we've got the agencies. Again, government needs to use financial records because they need to look at things like tax. How much are you going to tax a particular company? If we're looking at NASPERS and process, same thing applies. Do they pay tax? They definitely do. And how much tax are they going to pay? Well, if SARS doesn't have an accurate set of financial statements, it would be impossible for them to evaluate how much tax a particular company is going to pay. So if we're looking at NASPERS and if we're looking at the tax that they're going to pay, if we go down to the bottom of the document, I just want to show you the actual taxes that they end up paying here. Profit for the year, we're looking for tax. There's it there. Okay, so if you had to look at the consolidated statement of income statement, you've got taxation here. All right, so have a look at the amount of tax that a company like this pays to the actual government. If you look at 2019 compared to 2020, obviously NASPERS is a global company, so their reporting documents, okay, their reporting financial statements are obviously in US dollars because it's international. So in terms of US dollars, okay, and there's an M here, so this is in million, you can see that in terms of tax, NASPERS is contributing just over 230 million US dollars. That's a huge amount for any government in terms of collections. $230 million. Okay, remember that's in dollars, so you'd have to times it by around 14, 15, depending on how strong or weak the rand is currently. You're looking at a few billion rand in terms of in terms of taxes. So it's incredible to see how much revenue these companies generate and their responsibility in terms of paying tax to the respective governments in the countries that they operate in. So please remember that when we're looking at financial management, everyone has a use for the financial information. Government would be a user and they would use the information to tax those particular companies. And then you get the general public. That would be you and I and everyone else. Are we interested in some of these companies? Definitely. Maybe you didn't know about these two companies until we had discussed them in the previous video that we had for week one's content. Now you know what or which companies are the biggest in South Africa. Okay, these are two of the biggest companies in South Africa. So when you're looking at these two huge companies, these companies are obviously important from a overall, let's refer to it as a country perspective. So the general public. Obviously, if we have more successful businesses, that will obviously create more jobs. So when businesses succeed and when businesses do well, that can obviously benefit the public. And sometimes the public would want more detailed information on those companies because sometimes the public isn't always treated fairly, perhaps. Maybe there are retrenchments and there might be disputes in terms of the fairness for maybe a dismissal if it's something like retrenchment. Obviously, retrenchments happen. It's part of business. But the point I'm trying to make is that users are going to want to know more information rather than less information. And then you've got management. This is always important because if you're going to make decisions internally, in other words, being part of the management of the organization, you're going to have to make decisions based on information. And if you don't have information, how are you going to justify those decisions that you've made? When you're in a management position, all the decisions that you make need to be backed up by some form of research or report or overall planning in terms of information, but you need to make sure that you have the evidence, that you have the information in order to justify why certain decisions have been made. It's important to understand what the different users are. And this is not the only users that you can get. There are many other ones. These are just the ones that the textbook has provided you with from a overall high-level point of view. You can obviously dig a little bit deeper and you can look at specific users. So what would you use the information for? Or what would someone else use that information for? Okay, the next part of the actual chapter focuses on the uses of accounting information. Something else that we need to consider. So now that we know who uses the information in terms of the user, are we able to identify the use? So in other words, the purpose. So in other words, what does the accounting information serve us? Or how does it serve us? And what does it do? That's something to consider here. So when you look at accounting, you'll see that the actual textbook has provided you with different questions regarding the use. So if you're looking at accounting playing a very important role in creating information that people can use, how do people use that information to their benefit? So I'd like you to choose one of these questions. For example, the first one says, how good or bad is the financial condition of the business? Notice that's a question that you would like to answer. So now you need to use information in order to establish how good or bad the financial condition of the business is. So my question to you would be, what are you going to look at? What information is going to give you insight in terms of how well a business is performing or how badly they're performing? And then you can also look at some of the other questions. The next one is, has the business activity resulted in a profit or a loss? Okay, that one we've seen already. Okay, we can see that Naspers is profitable. So is Process. Those are two very profitable companies, and that's why they're doing so well in terms of value. And shareholders like those companies because those companies are succeeding. They're using information and they're creating profit and they're making value. And obviously, businesses are doing well. So just remember, when looking at different types of businesses, you need to obviously establish what the use is, because the use is probably more important than who uses it. Because if you understand why someone uses the information, then you can make even better decisions. So please have a look at the rest of these questions. Choose one of these questions and maybe think in terms of your understanding and your ability to identify what they would actually use in order to make that decision. So, for example, which activities or products have been profitable? That's a business decision. So, are you just going to guess which of your products are profitable? Or are you going to guess which products you should continue making? Are you going to guess which products or projects you're going to start or build? Those are things you need to consider. So, if I'm looking specifically at the use, we need to understand how this information can be used to help the business grow. If you don't keep track of your different products and you've got, let's say, 1,000,000 different products or 100 million different products, how on earth are you going to make a decision on which products are selling and which products aren't? It all comes down to management. It comes down to accounting. The word accounting, just to keep it simple, to account for something means to keep track of it or to monitor it or to keep control. So when looking at accounting, you're looking at all of that information and you're looking at how it would affect decision making, because ultimately you want to make the right decision, and that decision generally requires a lot of information. Something else to consider here towards the bottom of this particular page, they talk about accounting is also useful in the following respects. And they've highlighted a few other considerations that you could look at when motivating why accounting is so good. Okay, so we understand that accounting is a language for communicating business transactions. It's important to understand how that information is communicated and presented to the users, because those users will use the information to make decisions. So if you're looking at this addition here, you can obviously see that accounting is a useful tool, and it can be used in the following instances. Increased volume of the business. Okay, increasing volume means maybe raising the sales perhaps, or making more products perhaps in terms of production. There's a lot that could go into increasing volume. The next point is looking at prepared on the basis of uniform practices. That's very important. All public companies on the JSE, irrespective of their size. So we've got Process, we've got NASPERS, and then we've got many others. Maybe you can think of some other companies. Maybe think of other media companies that you might want to work for at a later point in time. Are they public companies? Are they listed on the JSE, or are they private companies? Just to highlight this point here, that the accounting records need to be comparable. So in other words, we need to be able to compare one company against another, because that helps with the usability of that information. What's the point of having information if you can't use it to compare one company to another? And then you've got well-prepared records, which is a straightforward point highlighting how important it is to keep organized in business and to ensure that businesses keep accounting records and they are accurate and they are reliable. And then the last point here, B, if the media business is to be sold, then we need to establish the value of the business. And how would you do that? Well, you'd have to look at the financial statements. That would be the best way to identify how much a particular business is worth. And then you've got activity 2A, which I would like you to please consider and share your feedback on either WhatsApp or on Cold Campus to see if you're on the right track. Here we're looking at different advantages and benefits of using financial information. So why is it important? Why should we place so much emphasis on financial information? Why is this financial information or how is the financial information going to help us? Why do we need it? Why is it important? So please search the web and see what you can find, and maybe discuss some of that in the actual Cold Campus platform, so you can show the actual research that you found. Then I just want to highlight a few developments in the accounting field before we wrap up this particular section. When looking at accounting, just remember it's an international language of business. International means a lot of countries around the world use accounting and they follow these specific rules, IFRS. IFRS is one of, if not the most widely used accounting systems in the world, purely because of the number of countries that have chosen to use IFRS. Right, you do get the American system for keeping track of accounting records, but Americans obviously use that particular system, and it's not really used in too many other countries around the world. Right, IFRS is the most common purely because it's international, but that doesn't stop different countries for applying or implementing their own methods of accounting for certain transactions. Ideally, you'd want it to be an international set of accounting records that would guide you, because that would obviously ensure or give additional peace of mind in terms of accuracy and reliability. Right, you don't want to buy items from someone who's unknown. You'd want to purchase items from someone who is known. And the more information you have, the better. And that's why with IFRS provides us with information that we can share and that we can use in the decision-making process. And it's universal because as long as we follow the same rules, everybody's speaking the same language. I like to refer to IFRS as the dictionary, right? The dictionary for accounting, right? Like how you would get a dictionary for English words or other languages. A language is a language. A language needs a dictionary. So when looking at IFRS, that is the dictionary. That's where we go to identify the definitions for certain items and the rules that we need to apply. If you read more of the information, which you don't have to know, but it's nice to understand how big IFRS is. Okay, you can see over the years, right, the committee has obviously improved, okay, the actual standards to make the standards more accurate and to make the standards better. So it's important to understand that accounting standards are a work in progress. Nothing's perfect. Things can always improve. Things can always get better. And those are things that the board would manage and control in terms of the actual accounting standards and how the standards are implemented internationally. Okay, so IASB is obviously referring to the standards board that we have, that obviously sets out these rules that everyone needs to apply as long as they're following the same set of rules. Just something else to consider when looking at IAS. IAS is just the International Accounting Standard, and that's obviously outlined in the IFRS, the International Financial Reporting Standards. Right, just be careful of terminology. Terminology is used in South Africa. We generally refer to debtors, okay, instead of accounts receivable. That's more an American term, but it is pretty similar in terms of understanding. If you have amounts that are receivable, that means you're still going to receive those amounts. So a debtor would be someone that would owe you. Okay, debtors owe you because they're going to have to pay you what they owe. Then you've got creditors. Creditors are the opposite in terms of you're now making the purchase. Okay, you're buying from a particular company, and those companies that you buy from are called creditors. And then you've got sales. Another word for sales would be revenue. And you've got trading stock. Another word for that would be inventory or inventories or trading inventory. There's a few different ways of describing that as well. So please remember that there is a very important distinction that we need to make just in terms of overall understanding. As long as you've got the right term, I'm not going to mind whether you use debtors or whether you use trade receivables or whether you use creditors or whether you use trade payables. Effectively, it's the same thing, but it's important just to highlight that there are differences in terms of the information that's presented to users. Okay, I'm going to pause there for this session because the next section is going to be covering the two types of accounting in terms of management accounting and financial accounting. So this is a good place to stop. Please go over the content that we've just covered and please make sure you're doing those activities. More practice makes perfect, so I hope you're going through those. And if you have any questions, please let us know on Cole Campus, or you can email or message us and we will respond as soon as possible.